92% of professional fund managers, people paid millions of dollars to beat the market, failed to outperform a simple, boring index fund over 15 years. Not some years, most years. So what is this index fund that keeps beating the experts, and how do you get one? That is exactly what this video is about. Think of an index fund like a shopping basket for the entire stock market. Instead of picking individual companies and hoping you chose the right ones, you simply buy a tiny slice of all of them at once. The S&P 500 index, for example, tracks the 500 largest companies in America. An S&P 500 index fund owns all 500. Apple, Microsoft, Amazon, Tesla, all of them in one purchase. If one company fails, it barely dents you. If the whole economy grows, you grow with it. That is the power of instant diversification. Let's talk about the numbers that make index funds so compelling. First, roughly 10% average annual return on the S&P 500 over the last 50 years. That is the long-term average. Not every year, some years are up 30%, some are down 20%, but the average over time is roughly 10%. Second, fees. A typical index fund charges around 0.03% per year. A typical actively managed fund charges around 1%. That difference sounds small. Over 30 years, it costs you tens of thousands of dollars. Third, and this is the one that stops most people cold, 92% of active fund managers underperform the index over 15 years. 92%. These are experts with research teams and sophisticated tools, and they still lose. Not all index funds are the same. Here are the four main types. The S&P 500 fund tracks the 500 largest U.S. companies. It is the gold standard, broad, stable, and proven over decades. A total market fund goes even further, owning every publicly traded U.S. company, over 3,500 stocks, maximum diversification. An international index fund holds companies outside the U.S., giving you global exposure across Europe, Asia, and emerging markets. And a bond index fund tracks government or corporate bonds, lower returns, lower risk, useful for balancing a portfolio as you get closer to retirement. Here is how to get started in 5 steps. 1. Open a brokerage account. Fidelity, Vanguard, and Schwab are the top choices for index fund investors. All are free to open. 2. Choose your fund. VTI is Vanguard's total market fund. VU is their S&P 500 fund. Either is an excellent starting point. 3. Decide your amount. Even $1 gets you started on most platforms. There is no minimum on fractional shares. 4. Buy it. Search the ticker, click buy, and you now own a tiny piece of hundreds of companies. 5, and this is the hardest one, leave it alone. Don't check it every day. Don't panic when it drops. Let compounding do the work over years and decades. In 2007, Warren Buffett made a famous 10-year bet. He wagered that a simple S&P 500 index fund would outperform 5 hand-picked hedge funds over 10 years. The hedge funds had armies of analysts, sophisticated strategies, and decades of experience. After 10 years, the index fund returned 125%. The hedge funds averaged 36%. The index won by miles. And Buffett donated his winnings to charity. His conclusion: a low-cost index fund is the most sensible equity investment for the great majority of investors. Let me quickly bust 4 myths people believe about index funds. Myth 1. You need a lot of money to start. False. Many index funds have no minimum. You can start with $1 on most modern platforms. Myth 2. A good manager will beat the market. False. 92% don't over 15 years, and you can't know in advance which 8% will. Myth 3. Index funds are boring. No big gains. False. 10% average annual returns, compounded over 40 years, turns $10,000 into $450,000. That is not boring. Myth 4. I should wait for the right time. False. Time in the market beats timing the market. Every year you wait is compound growth you'll never get back. 4 things to remember. 1. Diversification. An index fund instantly spreads your money across hundreds of companies, dramatically reducing your risk. 2. Low cost. Fees of 0.03% versus 1% or more for managed funds. That gap compounds over time into a massive difference. 3. Proven performance. 92% of professionals lose to index funds long term. The data is overwhelming. 4. Start now. Time in the market is your biggest advantage. Every year you wait is a year of compounding you don't get back. Your move. Open a brokerage account today. Search VTI or VU. Buy your first share, then leave it alone. That is it. That is the strategy that beats 92% of the professionals. If this video helped you, please hit like and subscribe. New finance videos every Monday, Wednesday, and Friday. Wednesday, we're covering cash flow versus profit and why profitable businesses go broke. It is one of the most important concepts in business finance, and most people get it completely wrong. See you then.